right, we've got the big man here today. Chedo, how are you?
I'm fantastic.
You're
How
good?
are you, Bruce?
I'm doing well. Thank you for coming in.
Not a problem. Pleasure to be here.
Happy Friday.
I know. I'm glad it is Friday.
How was your week? Did you have a busy week?
Tough one.
Tough one?
Tough one.
You want to
I
talk
felt
about
like
it?
it was... No, not really.
Okay, fair enough.
I don't think we've got enough time for it.
Oh, look, we've got a good hour or so, whatever's on your mind, I don't really mind.
No, let's not. Let's just say by Tuesday I felt like it was Friday already, so it's been a long Friday.
I know exactly how you feel.
Yeah.
Yeah. You got any plans coming up over the weekend? Any
Relax,
sort of R&R?
feet up.
Yeah.
I started watching the Netflix series Better Call Saul. So I'm going to power through that.
Didn't that go through like its season finale?
Yeah,
or like
just recently.
the whole show finale? Or
I'm
was
not
that the
sure.
season?
I just thought I'd start it from scratch, and I'm going to binge watch it.
I heard it was really good.
Yeah. So far, it's pretty slow, but I hope it gets better.
Can I admit something?
Yeah.
I've never seen Breaking Bad.
See, I did. I saw that first.
Yeah, I've never seen it.
Yeah. Highly recommend it.
I know. Like people keep on telling me that, and it's just that I don't have time to go through 5 seasons. I just...
You'll start.
Yeah, I know. That's what I'm
get
afraid
through
of.
it eventually.
I'm actually afraid of starting and
one of
just
the
getting
best
addicted
shows
to it.
ever made.
I know.
I
it's
think it is.
incredible.
I
agree.
know. And I saw Jacob like face palming behind the scenes when I said I haven't seen Breaking Bad.
I agree with that.
Yeah.
I think it is one of the best. Yeah.
Yeah. Any other plans for the weekend?
No, not at this stage. Not at this stage. I want to get to the weekend
some
first.
sleep. Yeah.
Yeah, sleep, catching up a bit of sleep would be good.
Yeah.
But yeah, bit of re-energize the batteries and move on.
Great. Well, it might be a good idea if I introduce who you are first, right?
No, that's fair enough. Yeah,
We
for
could
the
spend the next
people who
hour
don't
talking
know.
about your weekend. So this is Chedo. Chedo is our accountant. Chedo's, yes, is that right?
That is correct.
Okay, because you went like this, I'm like, did I get that right? Have I got the right person here?
Yeah.
So Chedo is our accountant and does all of our tax planning. So we've invited Chedo here today to talk about the most exciting topic in the world, tax.
Exciting for me. Yes, it is.
How do you get excited about tax?
I think it's about strategy, not necessarily tax, but strategy.
Yeah.
You know, I got into accounting thinking it was all about numbers, and don't get me wrong, it is about numbers.
Yes.
And I was a mathematician. Like, I love my mathematics.
That's a good.
Yeah, and that's what I thought. But I love strategy.
Yeah.
And I don't like taking no for an answer. So when the taxman says you can't do it this way, well, I'll find a way you can.
I like you already.
So that's my view. So it's numbers, it is, but it's more about strategy, working with what you got, getting the optimal outcome, and so on and so forth.
Look, before we get into the really heavy tax questions, because I know there's going to be a lot of them, we've actually asked some of our staff members and our members to come and submit some questions as well. So I do have some questions for you.
Sure.
But before we go there, let's talk about your business first. Tell us about your business.
So Attune Advisory.
Yeah.
Attune Advisory in its current format, it's been around for about 5 years. And I recently did do a rebranding.
You did. I've got to say, the rebranding looks fantastic.
Thank you. So I thought it was time for sprucing it up a little bit and bringing it up to modern times. But basically, we're a boutique business advisory taxation firm. We deal with mainly SME clients, small businesses, and then individual clients, of which 99% of them are property investors.
So with, just for, the normal people out there, what does SME stand for?
Small, medium enterprise.
Great.
So all your mum and dad businesses, or even smaller businesses turning up to $20, $30 million.
Wow.
It's the sort of people we look after.
That's quite a big range.
Quite a big range. Yeah.
Yeah.
Technically, small businesses now classified up to 50 mil.
Wow.
Which I don't think
a small business is 50 million. Oh, Jesus.
Yes. So, but yeah, listen, that's the sort of people we look for. Anyone from mum and dads, we hold their hands to the process, up to people who have 30, 40, 50 employees plus.
Wow.
And then we've got the property investors, and that's my personal. My personal touch. I'm a property investor myself as well, so that's why I attract like-minded property investors, clients.
So tell us about the stuff that you guys specialize in, because I know property is one thing that you have a passion about. Mm-hmm. What else besides property?
In terms of industries and that?
Yeah,
we don't target any specific industry. We're probably a jack of all, master of none.
Yep.
If that's the saying. No, we don't target any particular. I like the fact that I have a variety of different clients, because you can pick and choose stuff from different industries and apply it to others.
Yeah.
So yes, and we got people from manufacturing, professionals, obviously, construction's a big one as well, obviously, down to health, you name it, we have it.
So anyone out there? Really?
Anyone out there?
What about individual tax returns and stuff like that? Did you guys do that?
Like I said, 99% of them are property investors.
Property investors.
Correct.
Great for our audience.
That's right. Exactly. So, listen, we don't have too many people who line up at our doors come 1 July getting their PAYG done.
Yeah.
It's not the target market we're after.
Got it.
Where it is more of a once-a-year relationship, those sort of clients. We're after those clients that we have those touching points throughout the year.
Yeah.
Rather than once-a-year relationship.
Great. Well, since we're on the topic, let's talk about property.
Sure, fantastic.
You like property?
I do.
You better.
I do. See, my property love comes from my younger years. A lot of my family were in construction.
Yeah.
So my school holidays were built around go with dad on the building site.
So your family's from a construction background?
Correct.
From a construction background.
Yeah, so when it was school holidays, Mum used to hate me and my brother being at home doing nothing and running up the walls. So she used to send us with my old man on the building site, go help dad. And that's where the love for construction came, and the love for the
we
property.
Actually have something in common because my family has a construction background as well.
Mm-hmm.
I don't think anyone even knows this, by the way. But my dad, he used to be in construction. Not anymore. He's in the restaurant business these days.
Yep.
But when they first migrated here, they were in construction.
Well, that's the common job for immigrants.
Absolutely,
right?
yeah.
Labor and construction,
Correct.
and that's what it was.
Correct, yeah.
And that's how I got to love the whole idea of seeing something starting off with a block of land and then a residential property by the end of it, and you're like, oh, that looks great.
Yeah.
And that's where the love for property came. I'm going to be completely honest.
What nationality are you?
Background Serbian.
So that's something in common. You're right, actually. A lot of migrants do come here with a construction background.
They do.
Because not just my dad, but a lot of my family members, when they came here, they all went into construction. And they used to work for, I think it was the Greeks and stuff like that. Because the Greeks came in before us.
Correct.
Before the Chinese. And they started up the whole construction boom. And then the Chinese came in, they started working for the Greeks.
Correct. Trying to find work where you can to keep the family.
That's right, yeah.
Yeah, put food on the table, and that's what it was.
Yeah.
So I do look up to, when I say my parents, they're the people I look up the most.
Wow.
Because they came here with nothing.
Yeah.
And here I am sitting talking to you about my business and where I've come from. So they're my idols. But that's where the love for property and property investing came. Seeing the construction process, seeing something being built from nothing. I do like to get my hands dirty as well when it comes to that sort of stuff. Don't get me wrong. So I am a renovator too. So I'm not someone who just sits behind a table punching numbers on a keyboard. I do get my hands dirty, but it makes me appreciate what I do in my day job as well.
That's great.
Yeah.
So, I mean, like in your own property journey, how has that looked like for you personally? When did you start?
I started off back when I was 18.
That's really young.
Yeah.
Yeah, that's good. How old did you say? How old are you today?
35.
Well, that's good. Well, that's a good solid, almost 15 years or more. Yeah.
Yeah. So I remember buying my first property when my wage was $27,500 per annum.
Wow.
And
how did you manage that?
Yeah, I know. So the property I bought
back then, like
I still own that.
It was cheaper.
I still own that property today.
Yeah.
Purchase price was $170,000.
Where did you buy it?
Where?
Yeah.
Gold Coast.
Oh,
Coombaba.
House?
Nah, terrace.
Oh, mate.
In Coombaba.
You've done well. You got it today.
I still got it today.
Man, but Gold Coast is going crazy.
That's right.
Yeah.
So that was my first one. I remember I was working as a cadet accountant.
Yeah.
For a city-based firm on a cadet salary, which was $27,500, and I was able to borrow 80%. I had my savings, and that's what started it.
Wow. What motivated you? I know, like you mentioned, your family in construction, but obviously you had to make a decision for yourself as well. What motivated you to get into the property market at 18 years old? Because that's not typical.
Well, I guess at a young age, I knew money in a bank account was dead money. So
that's why you're an accountant today, I suppose.
And that's why I am, I guess.
Yeah.
It goes together. So, that's what it was. And I sort of had a thing for tangible stuff. Don't get me wrong, even at that age, I sort of got into shares as well.
Yeah.
But, constantly clicking the refresh button at 10 o'clock and at 4 o'clock, waiting for the market to open and close. And the volatility I didn't like. I prefer the whole sit and forget strategy at that age. And then having that connection with how it came about through family and the construction industry. And that's what, you're told to do, invest in property at that age. And I do remember that even in high school, they were saying that's the thing to do.
Wow. So from your first one, what happened after that? Like, what was the journey after that?
Well, at that point in time, things kicked off quite well at Gold Coast market.
Yeah.
And I was able then to multiply and do the domino effect, pull out equity, continue buying, pull out equity, continue buying, and then the market slowed down, and then I had to wait till I saved more money and then continued on with that. So a lot of those first handful of properties I purchased was just purely based on my own research.
Mm-hmm.
Don't get me wrong, I made some mistakes.
Mm-hmm.
We all do.
We all do.
We all do, and you learn
yep.
from those. But it's what you take from those mistakes and I guess how you move on, which is most important. And there was a period of time there for a couple of years where I didn't do anything. I was a bit more concentrated on the career.
Yeah.
And didn't have time for investing in property.
I went through that myself too.
And you do.
Yeah.
And you do. And then you get back into it, and then interest rates started going back up, and then you start reviewing your portfolio, and then so on and so forth. I remember interest rates for me at one stage were 9.9%.
Yeah. I remember that.
Yep.
I remember that.
And then trying to get out of it, paying exit fees of about $4,500 per loan at
Correct.
times 3 loans, you're like, what am I going to do? So, not like my parents who say interest rates were 18%.
Yeah.
But, and I guess it's that you go for ups and downs and review your portfolio and you move on and keep going, keep building.
Absolutely. Like, I can totally relate to that. Totally.
Mm.
You mentioned you made some mistakes.
Mm-hmm.
Do you mind sharing some of those?
Yeah.
What's one big mistake that you made that you think would be a good lesson for our viewers?
One big mistake I made was not doing enough research when hearing some advice. So I took one person's advice as being gospel.
Yep.
And didn't check the credibility of it. And I invested in an area based on that.
Yep.
In hindsight today, it's doing well. But I probably
Time heals all wounds,
That's
as they
right,
say. Yes,
exactly.
Especially for property.
But it took me 7 years before that happened.
Yeah.
So I guess my money was sitting there doing nothing for that time.
Yep.
And you learnt that. However, the local planning changes that this person was advising was going to happen took a lot longer to happen in the Logan area.
That's always
in
Logan.
Queensland.
Talk about Logan
Yes.
in Queensland. Yes.
Yep.
Yes.
Took a lot longer for it to happen, and there I'm sitting with a property that didn't move for 5-6 years.
Although Logan now is doing quite well.
Well, that's what I say. Now it's doing quite well. So I'm not looking back at it. It's not a bad thing. But at that point in time, that was the reason why I stopped investing for a period of time.
Have you still got that property?
I still do.
Well, there you go. You're still doing well
That's
today.
what I'm saying. They're still doing well.
Yeah, there you go.
As you said, time heals it all.
Time heals it all. Yeah. Very similar to the one I bought. I bought one in 2004.
Mm-hmm.
I actually lost money on it. I didn't even make money. I lost 50 grand on that property. Bought it for 240,000, but today's worth over $1.2 million easily.
Yeah.
But I didn't have the capability to hold on to it. Yeah, that was my problem.
Yeah.
I wish I still had it just like you.
Mm-hmm.
Otherwise, time heals the wounds, right?
Mm-hmm.
So that's good. That's good.
That's probably one
early on mistake. I suppose that's the reason why we've chosen you as our accountant, because you've got that property experience.
I do, and I have the love for it, and I love educating people based on my experiences and clients' experiences as well.
Yeah, well, that's fantastic. So how, why, if you got this passion for property, how did you end up in accounting?
Why didn't I end up as a builder?
Yeah, or something in property.
At the end of the day, like I said, it all started off with numbers, and I do love strategy. So as much as I don't mind getting my hands dirty, I can't do that day in, day out when it comes to property. Whether I was sitting on your side of the table and being a property strategist or that, I don't know. It probably wasn't something that came across my mind. And I was probably too far into my career that I probably didn't want to take that plunge to try something new. So I just continued on with it.
Yeah.
And then eventually you start your own business, and here you are now, and you're heavily invested, knee deep, as they say, in your own business. So I use my business as furthering my property portfolio, as I say to my clients, and it continues allowing me to continue buying, developing, doing what I want to do.
So it all comes back to your property portfolio.
It does.
Yeah, that's good.
It does.
When you got a chance to help out others as well with their planning, right, with their tax and stuff like that.
Exactly.
Because property is we'll talk about it later on, but property is a big part of tax planning.
It is, and it's one of your largest assets that people invest in, and it's the one they always say you should always have as part of your investment strategy.
Yeah.
A property, whether it be the house you live in, even the house you live in, I classify that as your part of your portfolio. It is an investment.
Absolutely.
You may not be getting a rental return week in, week out, but it is something that will grow in value.
Well, it's going to add to your net worth in the future.
Exactly.
Yeah. So your accounting firm has been around for 5 years.
Yeah, correct.
What was before that? Was that the first business you started?
That was when I went off and ventured on my own.
So before that you were working for?
Yeah, I was an employee, and I was a partner in a firm in the city, and then there was just a misalignment in terms of values. I always like to put my clients first, and
As
money
do we.
and money second.
Absolutely.
And there was a bit of a misalignment.
It's funny when you say that because that's such a simple concept that
it
so many
is.
people get wrong,
and
don't
as soon
they?
as you lose that, and I started seeing cracks in the business
Yes.
I was in, and I said it was time for me to move on.
We've got a very similar journey, you and I, Cedo. A lot more than you
We
imagine.
should catch up more often.
We should. Very similar in terms of like the construction background, how you got into property, all that kind of stuff. I went through everything, even how your business started as well.
Yep. And then fast forward here around 5 years later.
Yeah.
And don't regret it at all.
Yeah. Wow.
Yeah.
What an amazing journey. Only 33 years old as well.
35.
35.
Thank you.
Mate,
I'll take the 33.
Yeah. You got plenty of time ahead of you. Plenty of time.
I do.
Yeah.
Don't let the grades fool you.
Absolutely. I think I've got more grades than you though. So let's get into the reason why you're here and get stuck into some of the tax questions.
Sure.
You ready to talk about tax?
Yeah, then throw it at me. Let's go.
All right. I've got some questions here from some of our staff members. Open-ended question we'll start off with. In your opinion, how important is tax planning in someone's life?
Very important.
How in terms of scale, in terms of like if you were to put like, for example, the importance of something, there's someone's career, their business, their family, their health, where would you rank the importance of having a good tax plan?
I don't know if I'll rank it up there with those, but I would rank it as important.
In the top 5?
Probably number 5, number 6.
It comes hand in hand in wealth, if you ask me.
It does. You need to. And the thing is, I'm still trying to develop that time machine to go back in time and help people. But until that happens, planning ahead is important. Too many times the clients come to me and say, well, this is what happened. Well, if I knew then, I could have assisted you at that point in time. Now it's too late. We know the financial year finished at 30 June.
Yes.
So what's happened in the year before, it's done and dusted.
Correct.
And for me to make changes is either going to cost you money in fees or it's going to cost you money in tax. So dealing with it at the time when it happens, that's planning. Dealing with it progressively throughout the year, that's tax planning as well. It's planning for the end of the financial year. So if I can metaphorically say, it's like a production line. The finished product is your tax. What happens in the production line determines your tax. So having an accountant that you can reach out to on a regular basis, run your ideas. I'm just one person who sits on that round table, along with, if we're talking about property, the property strategist, a good broker, without money you can't borrow, and a good lawyer as well.
Also about having the right team around you, right?
Exactly.
And tax is just one part of that team.
It is. We're just one of those key professionals helping making clients' life decisions easier.
I always said that there's literally 3 people that you need to have in your life. Actually, no, 4. So 4 people you need to have in your life to make sure that things are taken care of. A good doctor.
Yep.
Yeah.
Health. Yep.
Health. Good broker. Good accountant. And a good mechanic.
Mechanic?
Yeah.
I haven't heard that one.
I just threw in there because I know how painful it is, like to try and get your car fixed and get scanned by mechanics that try to charge you too much.
Yeah, that is true. That is true. I'll have to give you that one.
Yeah, but like you can say the 3, right?
Correct.
Yeah, the 3.
Well, if you can't get money, how are you going to invest in property?
Exactly.
And if you're going to sit there, and I think I've seen you say the time for you to save enough money for property, the market's moved so many times. So,
correct.
Yeah.
Yeah, correct.
Yeah.
So on the topic of wealth planning, so a lot of people have accountants, right? And you talk about this idea called wealth planning. And one of the most common questions we get asked is like, how do I get the most out of my accountant? Because it's not like my accountant comes to me with a plan. And I only get to see them once a year anyway. So what would be...
Well, it shouldn't be. You shouldn't see them once a year.
For some reason or other, it happens that way anyway. So what would be your tip in relation to, if you had an accountant, how do you kind of get the most out of your accountant for your benefit?
Sure. Good question. So I sort of try to explain this to prospective clients when I'm sitting across the table with them. With small businesses, because of access of real-time data, software and that, I see financial data for a small business on a daily basis.
Yeah.
So when I see something that's all right, I pick up the phone. Hey, Bruce, what's going on? Your receivables are blown out of proportion. Your bank, you're going to be out of money based on cash flow in 2 weeks' time. What's happening? I can only see the financials. I don't see the quantitative data, and that's where you got to speak to and saying, oh, you know what? I do have orders coming and so on and so forth. For individuals, you don't have the liberty of that. So we as accountants don't have the liberty. So a lot of times when I sit across the table of a prospective client, it's, my accountant's not being proactive.
That's the most common complaint I get
Yes.
about accountants, that they're not being proactive.
But we don't know what we don't know.
Yeah.
So I say to him, we need you to reach out and say, this is what we're thinking of doing. Then we can set out a plan for you. This is what my next 6 months looks like. Oh, I'm going to change jobs. I'm going to go on maternity leave. I'm thinking of buying investment property number 3 in 3 months' time. What do I need to do to be prepared for it? Only then can we assist.
Gotcha.
But you sitting at home on the couch thinking about it,
Gotcha.
I'm not going to know that.
See, I think that's the missing link, because from my experience, most people haven't thought about those things. So they haven't got a reason to call the accountant with a plan, because there is no plan.
Yep.
And there is no, I want to buy an investment property in 3 years, because they haven't even thought about it.
No, that is true as
Because
well.
most people are just going through a day-to-day 9 to 5 doing what they do.
Yep.
Which is why I think what you said is important, because it actually fits written right nicely into what we preach as well, which is the importance of actually having a financial goal and a financial plan in the first place.
Exactly.
Because without that, there is no conversation with your accountant. So I guess it comes back down to simply having
A conversation.
A conversation.
It's
having
having a
wealth plan.
conversation.
Exactly.
And then it is up to for the accountant to make you accountable on that.
Yeah.
And reviewing that.
Yeah.
No different as any other goals and plans you may have. Whether it be at the beginning of the year to lose some weight and you jump on the scales every month and check that. It's no different how you're progressing. And that's what it is. So it does take the initial step to be done by the client. And then obviously then the accountant can be involved. But yeah, that's the only thing is the disconnect. We don't have the thinking process of what you're thinking right now coming to us.
You shouldn't.
No.
Right? Because you don't know what's going on inside your person's mind.
Don't. Whereas
you're not mind readers.
No, and with a
Yeah.
small business, like I said, it's different. We've got the access to financial thanks to technology.
Yeah.
And we're very much pro-technology at Attune Advisory.
Yeah.
So we see that, but that at least then starts a conversation that the client may not have been aware of.
Understand.
Yep.
Yeah, great. That's the key takeaway, I suppose, is to make sure you got a proper plan, which we can help you with, and then loop in your accountant when the plan takes shape, and when the accountant comes in, they can give you the proper advice around the plan, around the tax side of things. Another common question we get are different types of tax entities, right? What are the different types of tax entities? And as a kind of like a lead into the next question is also, what are the pros and cons of buying property under personal name versus a trust? So let's talk about the different types of tax entities out there at the moment. What are the types of tax entities?
Very simply put forward is obviously an individual in your own right. You've got potentially a company, and then you've got a trust. A trust is in two parts. It's either a fixed trust or a unit trust, as it's referred to, or a discretionary or family trust. Now, don't get me wrong, you can have hybrids of those as well. I don't think we have enough time for that today to go into that, but that's the most simple.
That probably requires its own podcast.
That's right.
Yeah.
It does. It does. And even multiples of those as well,
Yeah.
depending on the structure. But that's probably the most simplest form of structures there are.
Is super considered a tax entity?
It is. It is
Yeah.
a form of trust.
A form of trust. Okay.
It is a form of trust.
Okay.
Okay. It all is holding the benefit for the members for their retirement.
Yep.
What is suitable for property investing, depending on the strategy of that property. So there's no one rule fits all. Okay.
Well, let's talk about the pros and cons of each one. So let's start off with maybe personal name. What would be the pros of buying property under a personal name?
Finance is simpler.
Yep, finance.
CGT concessions.
So CGT concessions, let's break that down. What does that mean?
So CGT, obviously, upon any sale of any investment, assuming you've held it for more than 12 months, you're eligible for a 50% discount. As an individual, you are eligible for that.
So CGT is capital gains tax?
The difference between what you bought something for compared to what you sold it for.
Yeah.
Correct.
Yeah. So after 12 months, you get a 50% capital gains tax discount after holding the asset for 12 months.
Correct.
My understanding is that that's not just applied to property, but it's for any
All
asset.
investments.
All investments. So it's
Correct.
shares, cryptocurrency, everything
Whatever
is
it is.
included. Yeah.
Yep.
Great. Do you get that 50% discount under a super as well?
You don't get 50. Superannuation gets a different discount.
Yeah.
But there is a CGT discount, correct. So for individuals, anything investments held personally, it is 50%. When it comes to superannuation specifically,
Yeah.
normally you pay tax at 15%. If you have a CGT event and hold it for more than 12 months, you pay tax at 10%. So you receive a third discount.
Okay, that's bloody good.
Yeah.
Yeah, still great. So those are the pros. What about what did I say? The pros.
That was a pros.
Pros. Those are the pros.
Yep.
What are the cons?
Limitations, asset protections, probably the biggest one, although you could mitigate that by always being highly leveraged. Banks always first.
Hold on, explain that.
Well,
How do you mitigate asset protection by being highly leveraged?
well, it's your equity at exposure, right?
Yes.
So if the bank's the first mortgage and it's highly leveraged at 80%, and you had to do a fire sale,
Yeah.
the bank will be the first person there lining up saying, "Give me my proceeds first." So it gives very
Right.
limited amount to creditors, depending on the line of work you're in.
Right.
Now, as a salary and wage PAYG,
yeah.
very low to no risk. Whereas if you're a sole trader who's on a construction site, working as a contractor, potentially your risk might be higher. You might do something wrong and be negligible in your act.
So if you're a business owner, for example.
That's right. Exactly.
Okay. So just to simplify the conversation here, so the cons would be if you're a business owner, or you run sort of like business practice, might be better putting in a trust to protect, to separate
segregation.
the property from you as an individual.
Because what you don't want is you don't want what you're building in wealth to be jeopardized by what you're doing in your 9 to 5.
Right.
Otherwise, what's the point?
Yeah.
You're working hard only for this to be at risk.
Yeah.
Correct. So that's one of the biggest asset protection, probably the biggest one for individuals. But as I said, that can be mitigated based on leverage of debt.
Gotcha. And in terms of if we go down the trust structure, in terms of tax differences, what would the main tax differences?
So trusts are good. When it comes to property, the issue with trust is the biggest. Let's talk about cons first. Let's talk about cons first. The biggest con with property investing trust is land tax.
Yes.
So, and it's a state jurisdiction. So
I've made that mistake in the past.
Yes. So every state has its own threshold. So New South Wales, it's assuming. And sorry, when I say trust, I'm now talking about discretionary family trusts. Every state has its own threshold. So in New South Wales, it's 0. So you start paying land tax on the first dollar.
That's on a trust, but not in an individual.
No, correct.
Because in an individual, there's a threshold, a minimum threshold.
Correct.
Yeah. Yes.
Whereas with trust, you don't get that in New South Wales.
Correct.
In Queensland, you do to a decent amount, and every year it's changing based on indexation. In Victoria, it's a very small amount, and so on and so forth. So that's a holding cost you've got to take into account if you're setting up a trust or buying property in a trust.
And that's quite a lot, isn't it?
It can add up.
It can be.
It can add up quickly.
Yeah.
Not to mention the setup costs of a trust, not to mention the administration costs of it every year. You've got to file its own tax return, so on and so forth. So there is a lot more cost. So you need to weigh up the cost versus benefit of doing it.
Early on in my investing career, I bought a property in Sydney and put it under a trust without knowing this. And then at the end of the year, I got hit with a $6,000 land tax bill.
Yep.
It really shocked me.
Yeah, and I've had clients who...
And it wasn't even an expensive property. I think it was only $650,000 or something.
Based on commissioner's land value.
Correct.
So I've had clients who come to me with the same scenario, and then you do sit down with them and you sort of weigh up the costs. Well, what's the plan with this property? How much longer are you going to hold it?
Yeah.
Do we bite the bullet and transfer it back to individual name and pay the stamp duty?
Yeah.
That might only equate to 3 years land tax.
Correct.
If you're going to hold it for the next 5 years, maybe it's worthwhile doing it. Present value of money, so on and so forth. It is things you should consider. But a lot of people, unfortunately, jump into the trust because they think of asset protection first.
Yes.
And too many times have I seen prospective clients come to me who are salary and wage earners.
They don't really need it.
They don't really need it.
Not really.
And they buy it in a trust.
Correct.
I go, how many properties do you have?
I've
seen
first. I've seen that happen as well.
Yeah.
I've seen that happen as well. And like, where did you get the idea? I'm like, I went to a seminar. Somebody told me
Someone
this.
told me you should buy it in trust.
Yeah. But you don't really need it.
No.
Yeah.
You may not need it.
It
may not be applicable.
You may not. Correct.
Yes.
Correct.
You may not.
Yeah.
And that's the mistake people make. So obviously, administrative costs, setup costs, land tax is the biggest one when it comes to property investment. When it comes to trust, trusts are good in terms of streaming income.
Yes.
So meaning that no one individual or enterprise or entity is entitled to that money until the end of the year, and then you, as a trustee, or as the trustee, decide who that is. Yeah. So you, Bruce, can decide at the end of the year, I might give 20,000 to brother one, 15,000.
And that's where tax adventures come in, right?
Exactly.
Yeah.
So that is the pro thing when it comes to trust, because you can income stream each and every year, and never does it have to be the same.
So for the people who don't understand the terminology about that income stream, so how would you explain it so that people can kind of understand what?
So what it basically means is the trust earns the income throughout the whole year. At the end of the year, you get to decide who's going to be the beneficiary of that, and you get to decide the dollar value that gets assigned to each person. Never does it have to be the same person. So hypothetically, I've got one investment property, net rent after expenses might be $10,000. If I owned it personally, it would just add to my ordinary income, and I'll be paying tax at a marginal tax rate. If it's in a trust, you can then decide which family member potentially may have a lower tax bracket or not pay any tax, and you can then declare that income to them. They pay it at their lower marginal tax rate, which may be 0 or maybe 19 cents in a dollar compared to your 32 or 45, whatever it may be, and you're saving it a bit of tax there in that year. Next year, you revisit it again. It may not be that same person this time.
Yeah.
It may be someone else.
Yeah, and you can add beneficiaries in.
Correct, yeah. So generally, most of the deeds out there allow for multiple generations up and down of the primary beneficiaries and generations side to side. So what that means is parents, grandparents, kids, grandkids, great-grandkids, and then uncle and aunties. So it does create a big family circle that's available to you to use.
Is there a minimum age?
No, there isn't. What there is, though, is minors are receiving income.
Yeah, I was going to ask about
issue.
That's an issue.
That's an issue, correct.
Yeah.
So minors can only receive a few $100s now,
right.
which is not...
So what's classified as, what age can they be before they can receive a proper income?
16.
16, okay.
Yeah.
16. So probably good if you have like kids under 20 and parents over when they're retired.
Exactly.
Because they're not working anymore and not earning an income.
Correct. So if it's a family with a newborn, well, you're not going to really get the benefit of the minor for the next 16, 17 years, whatever it may be.
Of course,
that's right.
yeah.
And there's other things to be mindful of as well is that any distributions that do happen to your dependents, being your children, that it is done in a way that it's probably in lieu of school fees, tuitions.
Right.
Otherwise, you could have an issue where the kids could ask for that money at a later point in time, saying they never received it.
Interesting.
But that's another topic again.
That is another topic. Yes. All right. Well, that's good because I actually learned some stuff that I didn't know about.
Yeah.
That's really, really good. So let's talk about negative gearing within a trust. Can properties be negative geared? If so, how? If not, why?
It can in a trust. Unfortunately, the downside is it carries forward until it has income to offset.
Yes.
So if your rent, obviously, if your holding costs outweigh your rent that comes in each and every year, normally for an individual, that will offset your salary and wages. So you receive a tax refund because of the negative gearing. In a trust, unfortunately, you can't distribute losses. So that has to carry forward until such point in time that you have enough surplus income to offset that negative loss.
So if you had, for example, a property, I'm just putting it out there, just giving a real life example so people can follow this. So imagine you've had a trust, and in the trust you had a property that was fully paid off, and that property was generating rental income, and the rental income was going inside the trust. And let's just say it was taxed. You had to pay tax on that rental income. Then you had another property which could be negative geared. In that situation, could you... The
two offset each other.
Could they offset each other in that case?
Correct. But if you had a client who came to you and the property being advised to purchase first is going to be negative cash flow, well, you're not going to get the benefit of that until you have the one that has positive cash flow.
Correct.
So, again, this is part of the consideration of, is the trust the right thing to start off with or not?
Absolutely. Yeah.
You know, and then one of the downsides to that as well is that if it's all held under the one trust, then potentially it's like cross-collateralizing as well, and then they can both come into risk. So it does create other problems as well.
It does, yeah.
But yes, losses can be recouped against income within the trust.
It's just like an individual, just like any entity, right? Yep. Like if you're buying on your personal name, it's the same thing because you're earning an income.
Correct. Yeah. But you need to have that other income to offset. So you can't use your own income as an individual to offset in the trust.
Yeah.
No.
That's right.
That's the biggest difference.
That's the biggest difference. Yeah. Great. Okay, so that's good. Lots of really good information about trust and individuals, which is really good. Let's talk about old versus new property. Yep. What are the biggest differences in terms of tax deductions, old versus new?
The biggest one, obviously, thanks to the government and their constant changes and trying to help the property economy, is obviously depreciation. You know, what can and can't be claimed. Generally, it's just capital works now, presently. Who knows what that might be in 12 or 2 years' time. There'll be changes again. But the difference is second-hand property, you're not entitled to claim fixtures and fittings. So capital allowances, we're only allowed to claim capital works.
Capital works
is a structure. It's an actual structure. Your bricks and mortar, your roof tiles, that sort of stuff. Whereas your curtains, your carpet, that's capital allowance.
So with capital allowance, which is the fixtures, right? Would like the kitchen be considered a fixture? Or is that capital work?
It'll be capital works. If you're doing a renovation of a kitchen,
Yeah.
that's considered capital works.
Okay.
Yeah.
Okay.
If you're doing a renovation of a bathroom, that's considered capital works.
Right.
Yeah. So that's the biggest difference when it comes to buy a new and second-hand properties. The other thing I find also is a lot of people are attracted to second-hand properties because they can go and do a quick reno and increase the value. So one thing to be mindful there is, and a lot of people don't know, is there's a term called initial repairs.
Initial repairs.
So what initial repairs is basically, government says, ATO says, if for whatever reason there's half a roof missing on that house, and that's how it's being sold, but you now had to go spend $10,000 repairing that roof. If that roof was completed, you would have paid more for that property to start off with. So therefore, that repair is not actually a repair that you can claim in tax. It's what they call an initial repair.
Ouch.
Correct. It's called an initial
Ouch.
repair, and therefore it's capitalised.
Oh,
So there are a lot of
right.
people, a lot of clients I have who go out looking for those properties that are run down,
Yeah.
mainly in those lower social demographic areas,
Yeah.
where they can quickly throw a bit of paint and spruce it back up,
Yep.
and can get a quick equity injection
Yep.
in their portfolio. But you need to be mindful if there's holes missing in the floor, if there's a roof missing, if it was in its original good state and habitable state, you would have paid more, and therefore the government says in that case those repairs that are done initially are considered initial repairs and therefore need to be capitalised, not immediately expensed in that year's tax.
So let's talk about the definition of capitalized. What does that mean?
Capitalised means that you've incurred a cost, but it has a useful life of a number of years, depending on the item, and you can claim progressively over the number of years that its useful life is.
Right.
So something like carpet may be 10 years,
Yeah.
and if it costs you $2,000, you're entitled to claim, very simply, $200 a year for the next 10 years.
Yeah, got it.
That's what it is. Whereas if your tenant accidentally put his fist through the wall and you have to now go repair the gyprock, that's considered a repair, and you pay a handyman $500 to do that. You get to claim the full $500
in that tax year.
In that year, correct.
Okay, that's the difference.
That's the difference,
Yeah,
correct.
got it. So what about when you sell the property, right? Because I know that when you sell, there's a lot of tax implications. That's considered a tax event when you sell the property. What are some things for people to be aware of when they sell?
So one common thing that people don't realise is when you sell a property, the depreciation benefits you've received progressively throughout the life of the investment that you've owned it actually has to get added back and adjusted in your profit calculation. That's one big thing. Other things are obviously the common sale costs and those are adjustments that obviously get factored into.
Can I just stop you there?
Yep.
Can we just talk about how the depreciation gets added back? This is a very common question that we get asked.
Yeah.
Can you just clarify for people how that kind of works in a scenario? Let's just say...
Very simple scenario.
Yeah.
Let's say you bought a property for $200,000.
Yeah.
Good luck finding that one, but yeah, $200,000.
$200,000.
And
I'll buy today. Thank you.
And let's say you, over the 5 years of owning it, have claimed $2,000 depreciation each and every year.
Yep.
If me being an accountant, your book value of that property is $190,000. So normally you'd think, well, I bought it for $200,000 and I sold it for $300,000. I made a $100,000 gain.
Yeah.
In fact, you've got a book value of $190,000 being the original purchase price minus the depreciation, because you've claimed loss in value
Correct.
on a tangible asset.
Correct.
And you sold it to $300,000. So your profit's actually $110,000.
Understand.
And then you've got your normal adjustments that come with buying and selling, solicitor fees, agents, marketing, and so on. But that's what happens is basically it comes off your cost base, the depreciate. Now, some people say, well, what's the point of claiming it? Which is a common question I get when I have to break the news to them. This is what happens.
Yeah.
But my response is very simply, $1 today is not $1 tomorrow.
Exactly.
So you're getting the benefit of each and every year.
Yeah.
Not to mention that the fact that you've got an extra $10,000 of gains now, don't forget you get a 50% discount.
That's right.
So you're only adding back half of it.
Correct.
So you're still better off.
You're still better off at least 50%.
Okay. Not the time value of money as well.
And then one thing I add on top of that as well is that you can choose when you sell.
Exactly.
So you can choose to sell in a year where you haven't earned any income, as an example, which reduces it even more.
And make sure, don't forget, it's based on exchange date, not settlement date when you sell.
Yes, exchange.
It's another big one too, right?
Yeah. That's actually, I think I got caught out with that one because in my head, for some reason, I was thinking contract date, but it's actually exchange date.
Exactly.
Yeah.
So
that's a good point.
You got a plan. That's part of, I guess, your tax
So
plan.
you got to make sure you got to exchange before June 30.
or wait till after
Or
June.
wait till after, depending on the situation.
That's right. So I generally say to clients, wait till exchange on 1 July, and it gives you at least 15 months before you got to pay the tax.
Correct.
Yeah.
Correct. Yeah. Cool. Big questions answered. So let's see what the next one is. Let me see on my phone here. All right. So here's a good one. What are the most common deductions that people claim? Most common. Let's just say for a PAYG.
Any industry? Industry specific or no? I think
I
the moment...
I don't think we can make industry specific.
No.
It's so varied.
I think last couple of years due to COVID and that, it's been home office.
Home office.
Yeah. Working from home.
Yeah, that's a big one. Hey,
that's a big one. And ATO came out and basically gave a blanket rule saying for every hour you work from home, we're going to let you claim every cent for every hour.
Including rent?
Rent separate, yeah.
Oh, rent separate, okay.
Yeah. But that's probably the biggest one that everyone's obviously dipping their fingers into at the moment.
Right.
Second one will probably be, coming to that, is obviously use of your motor vehicle.
Well, hold on, let's rewind a little bit. So if someone's working from home, let's just say they work from home, out of a week they work from home 4 days and they go into office 1 day. Mm-hmm. So you're telling me the rent can't be claimed in that scenario?
You mean the rent you're paying?
The rent you're paying for wherever you live?
No, if you're being provided a place, if you're being provided a seat to work at by your employer, and you choose to work from home because you prefer to work from home, that's different.
What if you have to?
If you're required to, then you can.
Then you can.
Yes.
Okay.
So that's the biggest thing is people obviously were forced to over COVID to work from home.
Yep.
And a lot of people obviously gone back to the office now, being forced to go back to the office. Should you choose to for whatever reason, the answer is no.
What if the business by nature was a work from home business?
Then that's different.
Then you can claim.
Yeah, that's different.
That's really interesting.
So generally people, I've got clients who are sales and they're, the head office might be Queensland based, but they're based in New South Wales and they head up the New South Wales arm.
Yeah.
And they've got to drive around all day and they're the BDM for the New South Wales department. They haven't got a presence.
Yeah.
They haven't got a permanent establishment in New South Wales. They haven't got an office, so therefore that person works from home. That's different.
So I'll give you an example. So we've got some employees that are based in different states.
Yep.
But our head office is in Sydney. Mm-hmm. So you're saying those people that are in different states, they can claim their rent?
Yeah, because they're not required to travel to Sydney.
We should tell them. They probably don't even know that.
They probably don't.
Yeah, that's a massive.
So they're required they're required to work from home as part of the employment agreement.
Yeah.
Then that's different. Whereas people saying, oh, you know what, I want to work from home 1 day a week, and you guys being lenient and saying not a problem, we'll let you do that is a different thing. Even though there's a seat available over there for Tom.
Gotcha.
That's different.
Gotcha. Okay. I think that's a big one. I mean, I don't think a lot of people would even know that, actually. What about some most common deductions that people don't claim but should?
Most common.
That's probably one of them, what we just discussed.
Yeah, that is. I would say that. Yeah.
Anything else?
I think it just... most common...
I mean, let's talk about home office, right? Because a lot of people are working from home these days. Mm-hmm. So... what is actually claimable? Like the electricity?
Well, you got to be careful with the electricity one because, and you got to be mindful of is the property a place you rent or is the property a place you own?
Let's talk about rent to make things easy.
Make things easier, yeah. So you can do and sit there and work out electricity. Good luck doing that. I don't do that. I take the government's rule for every hour. We claim 82 cents in a dollar. And for every hour,
you just do that?
Just do that. Because being able to justify and have on record how did you work out what percent of your electricity relates to your little 3x3 room of a double-story house or a 3-bedroom or 2-bedroom unit is very hard to substantiate. So the ATO came out and said, you know what, for this period during COVID, we're going to increase the rate to make it easier for everyone so they're not pulling their hair out trying to work it out.
Understand.
And it's more than enough, in my opinion, of what they're giving in terms of the deduction you can claim.
And it's still at that rate at the moment?
At the moment, correct.
Okay. So there's electricity, and gas is under the same sort of thing. Yeah. Obviously things like internet.
That's separate. That's easy to monitor.
Telephone, stuff like that.
Yep, correct. You might have to buy some equipment. Maybe have to buy this table, or I want to start doing podcasts. So I'll buy the mics and equipment and that. Yeah. Again, some of those items have to be depreciated. Again, capital over the useful life.
So they can't be written off in the
some depending on the value, and they could be written off.
Is there a minimum threshold on
$300?
$300. Okay. $300
per item.
Yeah.
You can't say I've got to buy 2 chairs and a table, and it's $900 They go together as one. You can't sort of say each chair's
Oh, you can't do
300. No,
that?
you can't do that. So
Why?
don't think you can do that. Okay.
But they're individual items. Come on.
Well, without the chairs, there's no table, right? How are you going to
Yeah,
sit?
all right, fair
So
enough.
that's one thing, a common thing that I get asked.
Yeah.
But like that sort of stuff gets capitalized, and you get to claim it each and every year for the useful life.
That's interesting.
Mhm.
Okay. Wow, that's good. There's probably a few things I'm missing out on claiming myself, actually. Okay. Anything else you can think of before we move on? Because this is important. I think a lot of people would want to know this question.
Yeah, listen,
Yeah.
incidental travel, I mentioned.
Travel.
So incidental travel, people don't realise. And I think it comes down to record keeping more than anything. So
Yeah.
the problem is people don't keep their records or don't have a system of keeping records.
Yeah.
And it comes that time of the year to do the tax return, and then they're thinking, well, where did I spend money? What did I do? What did I incur? And for some people, without having a copy of an invoice or a receipt, they're not going to think about it.
Yes.
It doesn't come to them at that point in time.
That's
And
actually
unfortunately,
good. Keep records. of
Records is
everything,
very
yeah.
important.
Yeah,
They'll come
yeah.
to you 3 months later
Yeah.
when you've done your tax return and you
Yeah.
go, I should have done this. And can I go back? And then you got to then weigh up the cost. Do I amend my return? There's going to be a cost of doing that versus do I just forget about it and move on?
Yeah.
Yeah.
Yeah, okay. Interesting. So remember that, guys. Keep records.
Records
Keep
very important,
records. Make sure
yes.
you keep records.
Just don't come to with a shoebox full of receipts.
Yeah, actually, that's the next one. So
There's tools and software out there where you can take a photo.
That's exactly what I'm going to talk about. What are some tax tools for efficiency?
In general, or listen, I think...
Like just for record keeping, for
listen.
keeping track of stuff. Yeah.
Listen, there's quite a few different receipt tools out there where you can take a photo and it keeps a record of it.
I use Expensify.
Perfect. That's
Yeah.
a good one. I was going to say that.
Yeah.
In business, for businesses, we use another one called Receipt Bank. Same sort of thing. Takes a photo and it keeps a record. You can also send it to your accountant at the end of the year. Listen, even just having things for property investors, I've seen some people go to the extent of even using accounting software like Xero. Multiple properties. They treat each property as a separate business. Have its own profit and loss.
Each property is its own separate business.
It is.
If when you think about it.
It is. So how do you sit
It
there
is
and
its own
work out how
business.
they're performing?
Correct.
This is how you do it. That's probably the biggest ones. For people traveling, listen, thanks to our phones, it's easy to get an app now that can stop and start, work out your travel distance time, and it keeps a log of
Car,
it.
yeah.
Car. So
I have that as well.
yeah, so that way you can
It's
know how many
automatic.
That's
the
right.
GPS clocks it.
Exactly.
Yeah.
Exactly. You might just have to start.
It even knows when you're driving.
Yeah.
You don't even have to stop it because it knows when the GPS is moving around the car.
Yeah, and then you just got to work out the difference between your personal versus your business trips. So that's those tools out there as well. But I think the receipt one's the biggest one.
Yeah.
Too many times you go to Bunnings, for example, get a receipt, and then 3 days later it's faded out.
Correct.
And then it's no good come in the year. So if you can take an electronic version of that, retain it, and have a record of that you then give to your accountant, perfect. And that's what it is.
Cool. Anything else?
So
let's say receipt, record keeping.
yeah, so
There's travel. And travel is in the sense of driving, yeah?
Driving, yeah. So working
Driving.
out your kilometres.
Kilometers, yeah.
Correct. If it was Uber and all that, listen, you can download those.
There's also property investment tools.
Yeah, there is. So I think a good thing for property investors is having some sort of like a Excel property tracker that you can have all your data there for your properties.
Yeah.
I know I go to the extent of, and I'm one of those people who uses Xero, for example, for my own properties.
Yeah.
Why? Because...
Well, you've already got access to it.
Well, I do. Don't get me wrong.
That's your
not like
benefit,
it's
isn't
cheap
it?
though.
Yeah.
Not like I'm not paying for it. I'm paying for it. But again, how do I keep my records for my property investing? Is I have one central bank account used for all my properties. All rent comes either, all expenses go there. I use the tool to reconcile. I run separate profit and losses for each property at any point in time. So when I'm evaluating every few months how the property is going, it's a simple report, click on a button. Again, it's using the power of technology to make things easier.
That's actually an important one, how to structure your bank accounts.
Yeah.
How do you do it?
I have a centralized offset account where I have all my rents going to that one account. And
So you have all your rent going into the offset?
Yep. And I have all my outgoings for those properties coming out of that offset as well. So there's one centralized account known for my personal investments.
And so does that one central account capture all your properties or just one of them?
For the ones held under my name, correct.
Gotcha.
Yeah.
But how do you then differentiate which expense goes to which property?
I guess then it's your narration on your transfers.
Gotcha.
So I might call this one 36 Bruce Street or 35 Abba Street.
Because I run a very similar setup to you, but I just have different accounts for different properties. So I have one account for one property and that's it.
One account per property.
Yeah, so that it's all separated. So I know that this account is for my property here, that account for my property there, and then it's all separated. All the transactions are separated between each accounts.
Yep, that's going to a one step further than mine.
Yeah, because obviously you have to have multiple offset accounts which I pay for, blah blah blah.
Yep.
I mean, there's risk and outweigh pros and cons to both, right?
Yep. Yeah. And as long as you're using that correct account when you're paying from your drop down, then that's fine.
Yeah.
At least that you can look at the balance of each of your accounts and say, well, I know this is in positive. Oh, why is this one balance drop down a little bit? Let me look into that. Because
when the accountant asks for the paperwork, I just have to print out the report for that one account, give it to my property manager, along with my depreciation report, the rental statement.
Correct.
Bob's your uncle, off you go.
There's three things you send.
Correct.
And that's it.
That's all you need.
Exactly.
Yeah.
Exactly.
Yeah. Okay. Cool. Interesting. Oh, what else do we have here? Let's have a look at this. So we haven't really talked about super that much.
Mm-hmm.
How does super fit into someone's wealth planning?
It's definitely a lot of people you ask and they think, well, you ask them about super and they, well, it's not mine. I can't touch it. Wrong answer. Definitely wrong answer.
That's the wrong answer.
There's definitely wrong answer. Just because you're 30, 40 and you've still got a number of years until retirement age doesn't mean you should not think about your super. And I guess the pandemic has made people more aware about their super, especially when you have a global crash and the economic environment has a plummets.
Yeah.
And they notice, well, hold on, I was 90,000 in super last year, and this year I'm in 85. What's happened? And then it makes people think, well, what can I do to change that? So superannuation should form part of your wealth management. Whether or not self-managed super is for you, that's another question. But it does have its pros and cons as well.
That's a tough topic for another podcast. That can go very deep, can it?
It can.
We might actually not go down that rabbit hole today.
Sure.
We'll get you in another session maybe for that one. But yes, self-managed super is important. Think about it early on.
Definitely do. And you can make a contribution to how your superannuation performs by taking an interest and not just thinking, I'll just leave it there and when I'm 60 I'll open up that statement and see what my balance is and so on and so forth.
Yes.
Reality is that we are an aging population and less and less people are becoming eligible for the age pension. The thresholds are getting higher and the payments are getting lower. This is why the super guarantee requirements are now 10.5% for this new financial year. And they will eventually get to 12%. So they want people...
12%?
It will get to 12%, yes.
What makes you so sure of that?
It's already been legislated, just when it's going to happen.
Oh, has it?
Yes. Yep.
How long do you think that it will happen before it gets
I think it's going to get another 3 years.
That's
going to
not
go
long.
in increments.
That's not long.
No, it's not long.
Wow.
It's not long.
Wow.
So it'll be 11 next year, 11.5, 12. So 3 more financials and we'll be at 12%.
Wow.
So we've been going up 0.5% for the last couple of years.
Gotcha.
So the government wants us to be self-funded retirees because they're not going to be able to pay for everyone's age pension.
No, they're not going to.
So take an interest in it now. Don't wait. Even if it is changing your risk profile, even if it is reviewing your insurances that are in your superannuation, even if it is reviewing how that fund's performing in the industry or retail fund you're at, do take an interest and keep an eye on it, at least on every 6 months, if not on a minimum an annual basis.
Yeah, got you. You know, I was going to ask you for, to finish off the podcast, I was going to ask you what's your top tip do you want to give to audience members? But I actually think that just qualified.
Yeah, it would.
Take an interest in your super because that's bloody important.
It is. And it's definitely, it is yours.
Yeah.
Yes, you may not be able to get your hands on it now.
Yeah.
But you will be kicking yourself if you don't come age 60 or 65. Or who knows what retirement age will be in that time.
Exactly.
When you and I retire.
Yeah.
It may be 70. And you get to that stage and it could mean a difference between having 300,000 versus having 700,000.
That's a lot.
Generally speaking.
Yeah. Cool. Well, Chedo, thank you very much for coming in, giving us your words of wisdom and all your knowledge. It was great. I actually think this is going to be very useful to our members. And members, if you need any help with your tax, whatever it might be, we'll put Chedo's details somewhere down below so you can hit him up if you need to. And but yeah, thanks again.
No, thank you for having me.
Very
It was
good.
a pleasure.
I'll get
Enjoyed
you next time. We can talk about deeper into some of these topics.
No, fantastic.
That'll be good. Yeah.
More than happy to.
Cool, man.
Thank
Thanks
you.
a lot.
Cheers.
Cheers.
Thank you.